Shanghai launches tonight, and China is already paying $96 for silver. Before a single trade is placed, before Western markets even open their eyes, China has already made its move. $96 per ounce. Not after the rally, not during the panic, before. And that one word? Before is the difference between those who build wealth and those who simply watch it transfer. Tonight's Shanghai session is not just another market open. It is a signal, one that has appeared only 3 times in the last decade, and every single time, what followed changed everything. Welcome to Financial Crisis Explained, the channel where the numbers tell the story before the headlines dare to. Now, if you found this video today, think of it less as a coincidence and more as arriving at the right place, at precisely the right time. And if you haven't subscribed yet, think of it this way. You wouldn't leave the house every morning without your reading glasses, would you? This channel is your reading glasses for the global economy. Hit that subscribe button. Don't let the world move without you again. And before we go any further, drop it in the comments right now. Where in the world are you watching this from tonight? Because what Shanghai does in the next few hours may land very differently depending on where you're sitting. And the question that every serious businessman, every capital allocator, every entrepreneur sitting in front of a screen tonight should be asking themselves is not what is happening. It is why it is happening before anyone else is even awake. There's a particular kind of intelligence that separates those who respond to markets from those who read them. It is not found in the headlines. It is not broadcast on the evening news. It is not discussed at dinner tables or trending on social media feeds. It lives in the quiet, deliberate movements that occur in the hours before Western markets open, in the pricing decisions made in Shanghai, in the premium that one nation, the world's largest industrial economy, is willing to pay above and beyond what the rest of the world considers fair value. Tonight, that premium is $96 per ounce of silver, and that number is not an accident. To understand what $96 means, one must first understand what silver is in the modern economic architecture, because most people still think of it as a shiny metal sitting in a jewelry store window. That understanding is approximately 40 years out of date. Silver today is not a relic. It is not a sentiment trade. It is not something elderly investors hold out of nostalgia for the gold standard era. Silver is the material backbone of the 21st century industrial revolution. Every solar panel deployed across China's expanding renewable energy grid requires silver. Every electric vehicle rolling off an assembly line in Shenzhen, Shanghai, or Chengdu carries silver-based components in its circuitry. Every 5G tower, every advanced military communication system, every semiconductor wafer that powers the devices your audience is watching this video on right now, all of it requires silver at a level of industrial precision that no other element on the periodic table can replicate at scale. China knows this. China has known this for years. And tonight, China is paying $96 to make sure it has enough of it. Now here is where the signal becomes critical for anyone who considers themselves a serious student of economic strategy. The Shanghai Gold Exchange, known in financial circles simply as the SGE, is not a secondary market that follows Western pricing. That is a comfortable myth that Western financial media has perpetuated for decades. The reality, which serious analysts have been documenting with increasing urgency, is that Shanghai has become a primary price-setting mechanism for precious metals in Asia. And Asia, by every measurable metric of industrial demand, is where the physical metal actually goes. When Shanghai prices diverge from Western spot prices, when the premium expands to a level like $96, it is not noise, it is not a technical glitch. It is the market's most honest language, spoken clearly for those disciplined enough to listen. That language tonight is saying one thing with remarkable clarity. Physical silver is being valued far above what the paper market in the West is currently willing to admit. This divergence has a history, and that history is instructive. In each of the previous instances over the last decade where Shanghai premiums expanded aggressively ahead of a major session open, what followed was not a quiet correction back to Western pricing levels. What followed was a repricing event, a moment where Western markets were forced to catch up to what Eastern markets had already priced in. The catch-up is never gentle, it is never gradual. It arrives with a kind of velocity that punishes those who were watching the wrong signal in the wrong market at the wrong time. Tonight, that catch-up may already be in motion. For the entrepreneur, for the businessman, for the young professional building a strategy in a world that is restructuring faster than most academic institutions can document, the $96 premium is not a number to be observed from a distance. It is a data point, a rare one, the kind that arrives quietly before everything that comes after it arrives loudly. Shanghai launches tonight. And China did not pay $96 for silver without a reason. Most nations react to the global economy. China architects it. And tonight, while the rest of the world is still debating whether silver at $96 is a overreaction or an anomaly, China has already answered that question. Not with a press release, not with a policy statement, not with a kind of public announcement that gives everyone equal time to respond. China answered it the only way that actually matters in high-stakes economic strategy, with a transaction. There's a concept in military strategy called strategic patience. It describes the discipline of an actor who does not reveal intention through words, but through the slow, deliberate accumulation of position over time. A position so carefully constructed that by the time the opposition recognizes what has been built, it is already too late to build a counter. China has been applying strategic patience to silver for the better part of a decade. And tonight's $96 premium is not the beginning of that strategy. It is the moment the strategy surfaces. To understand the architecture, one must follow three distinct threads simultaneously, because China's silver accumulation is never driven by a single motive. It is always a layered decision: industrial, strategic, and monetary. All three operating in parallel, all three reinforcing each other, and all three pointing toward the same destination tonight. The first thread is industrial, and it is enormous. China has committed at the highest levels of state policy to becoming the dominant global manufacturer of solar energy infrastructure. Not a participant, not a competitor, the dominant manufacturer. The numbers behind this commitment are staggering in their scale. A single gigawatt of solar panel capacity requires approximately 20 metric tons of silver. China's current solar installation targets that have been revised upward 3 consecutive times in the past 4 years, require silver supply figures that the current global mining output simply cannot satisfy at today's pricing. This is not speculation, this is arithmetic. And China's procurement departments understand arithmetic better than almost any institution on the planet. The second thread is technological, and it is accelerating. Electric vehicles were once considered a consumer preference, a lifestyle choice for the environmentally conscious. That framing is now dangerously obsolete for anyone making serious business decisions. Electric vehicles are a geopolitical instrument. China's EV manufacturing sector, which now produces more electric vehicles annually than the rest of the world combined, is consuming silver at a rate that was not modeled in any mainstream commodity forecast written before 2022. Each vehicle requires silver not just in its battery management systems, but in its charging interfaces, its sensor arrays, its advanced driver assistance circuitry, and its thermal management components. Multiply that by millions of units per year, then multiply it again by the export ambitions China carries into every emerging market from Southeast Asia to sub-Saharan Africa. The silver demand that emerges from that calculation does not fit comfortably inside current supply chains. And China, which plans these supply chains with a time horizon that extends decades forward, is not willing to leave that gap to chance or to market availability. The third thread is monetary, and it is the one most people are not yet discussing. There's a quiet but well-documented shift occurring within China's reserve strategy. For decades, the conventional wisdom held that nations store value through currency reserves, treasury bonds, and gold. Silver was considered too volatile, too industrial, too messy for sovereign reserve purposes. That conventional wisdom is being quietly retired. As de-dollarization pressures mount, as the geopolitical cost of holding dollar-denominated assets becomes increasingly visible to nations outside the Western alliance structure, alternative stores of value are receiving serious institutional attention. Silver, precisely because it sits at the intersection of monetary value and industrial indispensability, is being looked at differently by sovereign strategists who understand that the next reserve asset may not be the one the textbooks currently recommend. 3 threads: industrial necessity, technological acceleration, monetary repositioning, all 3 converging on a single Shanghai session tonight. And China is already paying $96 to be first in line. The architecture is not complicated once you see it clearly. What is complicated is understanding why the Western world has taken this long to look up and notice it was being built. There's a particular kind of danger that does not announce itself. It does not arrive with sirens. It does not appear on the front page before it has already done its damage. It does not give the unprepared a courtesy warning or a second chance to reposition. It arrives in the gap between what is actually happening and what the Western financial world believes is happening. And tonight, that gap is wider than it has been in years. To understand the Western blind spot, one must first be honest about something that financial media rarely admits publicly, because admitting it would fundamentally undermine the authority that financial media depends on for its own survival. Western markets do not lead global price discovery for silver anymore. They follow it, and they follow it slowly. The architecture of Western financial infrastructure was built for a world where New York opened first, London set the tone, and the rest of the global economy adjusted accordingly. That world existed. It functioned with remarkable efficiency for the better part of the 20th century. the institutions, the analytical frameworks, the risk models, the commentary ecosystems, all of it was calibrated for a world where the signal originated in the West and traveled east. That signal flow has quietly reversed. And the Western financial establishment, for reasons that are equal parts institutional inertia, and geographical arrogance, and commercial incentive, has been extraordinarily slow to update its maps. Consider what happened in the three most significant silver pricing dislocations of the past decade. In each instance, the Shanghai premium expanded aggressively before the move registered in Western spot markets. In each instance, analysts operating exclusively within Western data frameworks described the subsequent price action as unexpected, sudden, or technically driven. In each instance, the move was none of those things. It was visible, in advance, to anyone watching the right market. The problem was not a lack of data. The problem was a lack of attention directed at the correct source. This is the Western blind spot, in its most precise definition, not ignorance, but misdirected focus. And for the entrepreneur, for the business owner, for the young professional building a career in industries that touch silver-dependent supply chains, the cost of misdirected focus is not academic. It is measurable in procurement costs, in inventory timing, in capital allocation decisions made on information that was already 12 hours old before it was ever acted upon. Think about what that means in practical terms. A manufacturing business sourcing silver-based components for electronics production receives its market intelligence from Western financial news platforms. Those platforms are reporting on price action that occurred after Shanghai already moved. The business owner, operating in good faith on the best information available through conventional channels, makes a procurement decision based on a price signal that is already a reflection of yesterday's Eastern positioning. By the time the Western spot price adjusts, the advantageous entry point is gone. The inventory costs more, the margin compresses. And somewhere in a procurement office in Shenzhen, someone made the opposite decision, 12 hours earlier, and made money on the same information. This is not a conspiracy. It is not a coordinated effort to disadvantage Western businesses. It is something far more straightforward and far more actionable once understood. It is a structural lag. And structural lags, unlike market manipulation or geopolitical scheming, can be corrected. They can be accounted for. They can be built into decision-making frameworks by anyone serious enough to restructure how they consume market intelligence. The question is not whether the lag exists. Tonight's $96 Shanghai premium is evidence enough that it does. The question is whether the businessmen, the entrepreneurs, the capital allocators watching this right now are willing to do the uncomfortable work of expanding their information geography. Because here is what the next 4 hours represent. From the moment Shanghai launches tonight to the moment London opens its eyes tomorrow morning, a window, not a large one, not a forgiving one, approximately 4 hours of distance between those who already know and those who are about to find out. The Western blind spot does not have to be permanent, but it does have to be acknowledged before it can be corrected. And for most of the Western business world tonight, that acknowledgement has not yet arrived. Every significant economic shift in modern history has contained within it a moment, not a day, not a week, not a quarter. A moment, a narrow, unforgiving corridor of time where the difference between those who acted and those who hesitated was not intelligence, not resources, not access to superior information. It was simply the willingness to move while the window was still open. Tonight, that window is open, and it will not remain open for long. The 4 hours between Shanghai's launch and London's morning open are not arbitrary. They are not a scheduling coincidence born from time zone mathematics. They represent something far more structurally significant for anyone who understands how global price discovery actually functions in the modern commodity market. These 4 hours are the period during which Eastern conviction becomes Western reality, during which a premium paid in Shanghai transforms from a regional data point into a global repricing event, during which the $96 that China paid for silver tonight stops being a number that serious analysts discuss quietly amongst themselves and starts being a headline that everyone reads simultaneously, after the most critical decision point has already passed. This is the architecture of the window. And architecture, by definition, does not wait for its occupants to feel ready. History has a precise and unsentimental record of how these windows close. In the spring of 2011, silver moved from $26 to $49 in less than 6 months. The majority of that move was telegraphed in Eastern market premiums weeks before Western analysts began revising their price targets upward. Those who were positioned before the Western revision captured the majority of the move. Those who entered after the headlines arrived captured the remainder and absorbed the volatility that came with a crowded trade. In 2020, as industrial demand signals from Chinese manufacturing began accelerating post-lockdown, Shanghai premiums expanded quietly while Western spot prices remained suppressed by paper market dynamics. The subsequent repricing, when it arrived, was not gradual. It was not orderly. It arrived with the kind of force that rewards early positioning and punishes late conviction. The pattern is not identical each time, but the structure is consistent: Eastern accumulation, premium expansion, Western lag, repricing event, and somewhere inside that sequence, a window, brief, defined, consequential. Now consider the three categories of actors that exist inside every such window, because understanding which category one occupies is the first act of serious strategic self-assessment. The first category is the early mover. This is the actor who has built an information framework that extends beyond Western financial media, who understands that Shanghai's premium is a leading indicator, not a lagging one, who has already made procurement decisions, portfolio adjustments, or supply chain repositioning based on data that the majority of the market has not yet processed. Tonight, this actor is not watching the window open. Tonight, this actor is already through it. The second category is the reactive adjuster. This is the actor who receives the signal with enough lag to still act, but not enough lead time to act optimally. They will read tomorrow's headlines, they will recognize the move, they will adjust, but they will adjust at a higher cost with less favorable positioning into a trade that is already partially crowded. They will capture some of what the window offered, not all of it. The third category is the one that no serious business person, no aspiring entrepreneur, no young professional building a long-term economic strategy should ever voluntarily occupy. The observer, the one who watched everything unfold, who understood in retrospect exactly what the signal was saying, who could explain after the fact precisely why $96 was the number that mattered, and precisely why Shanghai's launch tonight was the event that preceded everything that followed. Understanding without acting is not intelligence. It is the most expensive form of education available in a free market. So what does a serious decision maker actually do with this information tonight? The answer is not a specific trade recommendation. This is not that kind of analysis, and anyone offering specific trade instructions on the back of a macro signal this size should be approached with significant skepticism. The answer is structural. For the entrepreneur whose business touches any silver-dependent supply chain, electronics, renewable energy components, medical devices, advanced manufacturing, tonight's signal demands an immediate review of procurement timing and inventory positioning. Not next week. Not after the London Open confirms what Shanghai already told you. Tonight. For the capital allocator building a portfolio with any exposure to commodity-linked assets, the $96 premium is a data point that belongs in your risk framework now, not as a reason to panic, as a reason to recalibrate. For the young professional still building the analytical frameworks that will define their economic decision-making for the next 30 years, tonight is a masterclass in where real signal lives and how far in advance of mainstream recognition it tends to arrive. The window between Shanghai's launch and London's morning open is closing with every minute that passes. The $96 China paid tonight was not paid carelessly. It was not paid emotionally. It was paid by an economic architecture that plans in decades, executes in sessions, and has demonstrated, repeatedly and without apology, that it understands the value of moving before the world catches up. The decision window is open. What remains is simply the question of who is willing to walk through it before it closes.